And thank you for joining us for the next session that we have today, Win-Loss for Non-Consumers, using win-loss to understand your business buyers, from Eric Glickman, CEO of Fletcher CSI. In this session, we'll learn more about selling commercial and healthcare insurance and how that's a complex process, multiple factors to contribute to the decision on which carrier to use, and how to determine the best outcomes for using win-loss processes and benefits. And Eric is, as I mentioned, the CEO of Fletcher CSI, one of our sponsors for the spring workshops. Eric started Fletcher CSI in 1988 and has been active in the competitive and strategy consulting field since 1986. He's got a lot of experience performing qualitative and qualitative primary research used for competitive intelligence, and is one of the pioneers in the fields of win-loss, primary intelligence, trade show intelligence, and effective CI. As a sponsor, Eric, has an opportunity here to tell us a little bit more about Fletcher CSI before starting his session. And so, Eric, I'd like to turn it over to you.
Well, thank you, Mike, and thank you to all of SIR for participating in this session. We had a little bit of dead air there and a bit of background. When I was in college, I worked in college radio, and in college radio, you learn that the worst thing that can happen on a radio station is to have dead air. So I became very good at filling that with mindless pratter. My goal today is to provide you with something more than mindless pratter, something that might actually be useful for you as you're evaluating your sales to the non-consumer segments that are out there. Real quick on Fletcher CSI, been around since 1988. We focus on primary data collection and analysis to support strategic decisions. We're not going to help you develop your strategy, that's your job, but we'll help you identify the strategic choices and options you might have and what the competitive role and competitive environment is like for that. Win-loss is a key component of a lot of strategy development when it's used properly, because win-loss done effectively will identify what is most important to your customers when they're deciding who to buy a product from you or a service, how they make that decision, how you compare against those decision factors, and how you compare against competitors on those factors. So today's session is really looking at win-loss, as it says, for non-consumers, with non-consumers really meaning businesses. Obviously, businesses to a certain extent consume products and services, but for the purposes of win-loss, they are really quite different than what you might see from the consumer world. So in particular, what are some of the things that we want to talk about today? We're going to talk about the difference between consumer and business win-loss, how they are structured differently, the kind of information you get from them. I want to also address a little bit on some of the questions and what can be answered from business win-loss and how that is different than what you can get answered through consumer win-loss. And of course, where does the win-loss organization, assuming you want to build one, which is highly advisable, where should it fit in an organization? And finally, what does it take to put together a truly effective win-loss program? A lot of this is drawing on our almost 30 years of win-loss experience that we've been providing for companies, including insurance carriers of various types, and that we've been providing outside of the insurance space. So there's a lot of overlap between what win-loss happens in different is done and how it's done in different industries. In terms of where we're going to go, let's start with talking about the difference between business and personal customer satisfaction and win-loss products that are out there. Key thing is that when we look at business versus personal, there's some very, very different objectives in how the purchaser is approaching the market and what they're looking for. When we think about individuals, generally the first thought we have is that individuals are much more interested in things like price, right? They are more price sensitive than most businesses are. Generally, when we look at price as a factor in a decision, it runs about 4 to 7 in priority out of 10. So it's not usually the highest thing for business, but it is usually for consumers. Individuals are more concerned about the service and reputation that they're going to get. They might be impressed also with the market presence, how much advertising you're doing, what kinds of promotions you're offering, what you might do with community development, things that in the insurance industry, that would be what your agents are doing in the local community. For example, if you have dedicated agents, or even if you're using general agents coming through there, they would be people who are promoting insurance with general, and that's their market presence. Consumers also look a lot more for accessibility. How easy is it for us to get this product? Do I have to go through a lot of hoops, things like that? How easy is the transaction? Can I do this all in today's world? Can I do it all online? Or do I have to go into an office and sit down in front of somebody and make negotiations? Is it a really easy transaction or not? And a lot of times, why are purchasers getting insurance? I think our first morning kickoff presenter did a great job of saying insurance is a promise. It's a promise to pay or cover or help make you whole after a loss of one type or another. And that's why people purchase insurance. Now, a lot of times, admittedly, there are people who only buy auto insurance or homeowner insurance because you can't get a car on the road without insurance, or your mortgage isn't going to be issued without insurance. But it's also realistically about protecting against that loss. Companies, when they purchase insurance, generally are looking for different things. They're looking first and foremost for the level of service they're going to get and the reputation of the company that's going to present and deliver that service to them. They're also going to look for the market presence. How well do you know the industry that's that their business operates in? What do you have exposure to it? What can you offer in terms of advice around risk management and so on? And the network that you might offer. How easy is it for them to get a hold of an agent, to get a hold of a claims process and put through with that? We see a lot of it also on the integration. In other words, if I have to go from one carrier to another, how hard is it to switch? We know that in consumer, particularly in auto, for example, loyalty is pretty low. In business, the cost of changing providers, changing carriers, the cost of switching can be very high, and that becomes a key factor in whether or not the insurance that's going to be presented is something that's going to win. That's ease of integration. There's also employee satisfaction. If you're doing healthcare and you don't have a good network and your employees are complaining regularly to your HR department about how things aren't working, that's going to be a driver of getting change and looking for something different. Price, as I said earlier, it's pretty far down the list of what's important, but it is a factor in all decisions that come up there. And price is not just the dollars, but it's the total cost of ownership. How much does it cost to switch everything over? How much time does my HR department have to do to change the retirement plan or the healthcare plan? Or how much time do we have to go through to get new cards issued for our motor vehicle coverage, or any number of certificates that have to be provided? Those are all factors in that price. It's not just the policy charge itself. And of course, depending on what kind of insurance you're offering, it's also a tool to retain your employees, make sure they stay happy and protect against some of the liabilities that might be out there. We also know that there's different motivation levels within business itself. And a lot of that has to do with the size of the business itself. If we think of a small business, something with say under 20, under 30 employees, there usually aren't a lot of decision makers. It's the owner, it's the office manager, someone who's designated to do that. They're generally looking mostly about what's the price, how easy is it to make this transition, can I trust the agent I'm working with, whether it's a phone agent or not, can I trust the company, does it have a reputation that works for me? And in a smaller business, because the negative service impact is felt directly on the decision makers, there's not a lot of room for error in how you handle service and take care of claims and processing, or just basically customers calling and saying, is this covered or not? That becomes really important in small business. Mid-sized businesses, something with say between 100 to 500 people, usually a small committee. Might be the CEO, CFO is involved, might be the treasurer or some of the accounting people. We might have personnel involved in there. They're really looking for that protection, the coverage. What are we getting for it? Does it cover our specific needs? When you get into this size, there becomes a little more of a need for advice. What coverage should I have? How do I get that? What do I present this? How do I train my staff or my employees in using this product, whether it's healthcare again or liability coverages? How do I do this for safety and instruction to make sure that we're protected against that? Some examples. Price remains a factor, not as much as it is with the small business. And of course, that old transparency. Don't hide things from that mid-sized business. They want to know. In a large business, the national businesses, very rarely does the senior executive, the C-level suite, get involved in this. It's usually a decision team that's based upon the coverage that you're going to get. If it's health, you're going to have your union representatives. If you've got a union or employee representatives, you're going to have HR involved in it. You're going to have finance and payroll and all of those people in there. If you have a fleet coverage, you're going to have your motor pool managers in there, and all of those are part of this decision process. Lots more people involved overall. What kind of coverage you can offer? Is it sufficient for their needs? Is the service going to be good? Are they going to get what they want? These start to emerge as really important factors in there. We also find with larger accounts, it's that reputation. The reputation, you may think it doesn't matter that much compared to other things, but it's basically what gets you a seat at the table. So if you don't have a good reputation in the industry, it's going to be difficult to succeed. And we find that over and over again when we look at win-loss. And of course, regulatory issues. A lot of coverages are mandated, whether it's by the state or at the national level. You have to get that coverage. So now we're going to look at what's the most effective coverage we can get. So very different decision processes, very different motivations between the consumer world and the business world, and even within the business world based upon the size of that entity and where it's coming from. When we're doing win-loss in the business world, we do also find that there's a huge variation in the responses that you're going to get to why somebody chose or did not choose to purchase from you. Consumer world, right? You're going to do mass surveys. You're going to have thousands of people responding to it, mostly quantitative. Rank us on a scale of 1 to 10. We've all been through that where we purchased something, you renewed your auto policy, you renewed your homeowner's policy, you got a new boat policy or an RV policy, or if you're really well off and you're fortunate, maybe you got a new rider for the jewelry or something. Right? At the end of it, there's always going to be that little quick tick here for a survey. How happy are you with it? Super quant, lots of volumes to go through that. It drives a lot of decisions on how a company looks at that customer purchase experience. Might be some focus groups as well. And again, they're trying to take you through the customer journey and understand at each step of the way, what did the customer do for a decision? In the business side, responses are a lot lower. Usually it's in the tens, and 20, 30 deals might be enough for some companies for a year, depending on what their annual volume is. Maybe a couple hundred if you're doing 10,000 deals a year. Say, for your example, you're an insurance carrier for health insurance. You might have 30, 40,000, 50,000 business accounts in a state or in a region. You might do a couple hundred of those to get a feel for on a win-loss. Much more quant, much less quant, much more qualitative in that case, because you're looking for the nuances of what happens. So the type of win-loss you're doing in the business, as you can see, becomes much more of a qualitative assessment with more factors that have to be covered and more decisions around how that comes together. So as we look at it, at the end of the day, business win-loss, it's just different. Price is a much smaller factor in the decision. Relationship, coverage, service, your reputation, how you go into the market, those become more important. There are fewer competitors. If you want to go and get auto insurance, I think for most of us, there's going to be 12, 15, 20 different companies you can choose from for that, different carriers. On the other hand, if you are a business and you need health insurance, in most regions, there's maybe 5 competitors you can go to, maybe 6. If you're looking for good professional liability coverage, again, maybe a dozen carriers in that space. So that gives you a different type of universe you're working against. Sales cycles in business are longer. Most give you familiarity that we have most is with insurance for health insurance in the business space, where the sales cycle, that policy that you just got signed up for at the first of the year, the sales for that started somewhere around about 18 months beforehand. And the actual negotiation started about 12 months beforehand, and the decision was made a good 6 to 8 months before you actually had to switch over. Really much longer sales cycles. There's also generally higher values. You're not issuing a $600 6-month auto policy. You're issuing a $6 million 1-year policy, or maybe even $600 billion in coverage if you're looking at a real large national account. Coverages have different exclusions around them. They're much more tailored to the individual business that's buying these things. And the size of the company also has a significant impact on what you're offering. So if you think about it in the consumer world, right, you've got your typical homeowners, and then you've got the high income, high net worth homeowners who might have those $1 million plus homes. They get a very different policy than what you do if you've got a typical house in your area, and they get treated differently. Businesses are kind of the same in that respect. The process, I said earlier, is different. I want to go into a little bit about that right now as well. As I said earlier, depends on the size of the company. There are also, for many companies, specific regulations they have to do. They have to have for their coverage. If you're a long-haul trucking company, you're going to have coverages around the drivers and around the materials that are carried. Plus, you're going to have other pieces that you just don't find in the consumer world at all. And again, because of that, the businesses are coming to market with a different expectation of what they're going to get around that. When we work in businesses with win-loss, we find again that one of the features that is a differentiator is how much industry knowledge you have. And this doesn't vary depending on the industry. Sorry, this radio voice here, having a little bit of station difficulties. The industry knowledge is expected no matter what industry you are and no matter what coverage you're providing. In other words, if you don't know much about apartment management and you come into that space, you probably won't be well received compared to someone who does nothing but provide insurance coverage for large apartments. So having that and expressing that knowledge becomes very important. Again, in consumer sales, it's really not a huge factor. Consumers are generally, like I said earlier, looking at price. Businesses are looking at how well that coverage is going to protect them against loss. Brokers tend to have a much more important role. In consumer world, you generally go to the agent. In a lot of business policies, there are a number of specialized broker companies. Many of them are members of SIR that exist to help the company navigate the complexities of the coverage they need. Most companies don't have insurance agents running or doing their purchasing. They don't have people who are even experts in insurance. They might have a finance expert. Again, I said earlier, you might have the HR expert. You might have your fleet management, your property management experts who know all about that part of it, but they don't know about the nuances of the insurance coverage that's needed for that kind of a service or product. So that broker who tends to have that knowledge becomes a much more influential part of the decision. Consumers, you go to the agent. The agent knows their local market, knows their local customer base, not super helpful in the same way when you're looking at the insurance space for businesses. There's often a lot of different people involved in the purchasing decision on the customer side. As I said earlier, if you're a small business, it's usually the owner, CEO type person, or the executive, and maybe their office manager, finance manager. Mid-size, again, CEO, CFO, maybe one or two other C-suite type executives or people who would, in a larger company, be C-suite, but in a smaller company, it's not. When you get to a much larger organization, you're going to have multiple people. It's not unusual when we look at win-loss for large organizations to find that the evaluation committee had 10, 15 people involved in it, representing different parts of the company's constituencies and their needs. So they all have to be treated in this process. As I said earlier, longer lead times because every single one of these becomes a customized deal. the amount of times that a really large business will take something right off the rack is extremely rare. Much more likely to say, we have this feature, we want this added, this coverage added, made available. And that really is a big driver in what's different between business and consumer purchasing. So the triggers are also something different. When we look at consumers typically go to the market because it's renewal time. Policy just came out. I don't know if I got the best rate for my new renewal or not. I'll just do a quick call into the market and see what they're going to give me. That's similar also in large businesses, any business. It's renewal time. Let's just do a quick market check. Let's see what's going on. Make sure we're getting the best rate. Consumers and businesses both, if your coverage is poorly provided or the service is terrible or the carrier is leaving the market, they're going to go and look for another provider through. That's a very common trigger, by the way. Others are things that, apply for personal. I've changed my assets. I don't have this house anymore. I've changed my car. I'm looking for a new car. Same thing with a business. They've closed an office or they've moved or they've changed a division or something like that. These often drive a company to go to the market, even in the off cycle of renewals. Different triggers in business, acquisition, spinoffs. I suppose you could say that's kind of like a marriage or a divorce or the kids leaving the house, which I guess fits in as an acquisition, spinoff, and divestiture. But generally for businesses, they have a much more impact. There's also new regulations. We're entering into a new industry where you need a new coverage. A lot of businesses also have to go to the market to protect against new risks, things that were not out there 5 years ago, 10 years ago. DEI, for example, recruitment issues, retirement issues, so on and so forth, that now companies are feeling a pressure to protect against those risks. And there's also a go-to-market for, in particular in healthcare again, where it's the premiums. That's also true for the management of the company. But when employees start saying this is costing us too much, our co-pays are too high, the network isn't good enough, it's too hard for me to get coverage for the particular disease state I'm trying to address, that kind of pressure feeds up and leads to a decision to go to the market again. And then, of course, the industry dynamics themselves. If the industry is going down and there is less opportunity or there are more changes in the industry, that's going to drive a lot of companies to go to market. Very different. You don't generally see that on the consumer side in the same way. The important thing about all of this, consumer satisfaction surveys aren't going to capture these nuances. This is not something you can rely on a large quant study to give you the answer. One, because the universe size is generally smaller. And two, because a lot of the issues, you may get an answer on a scale of 1 to 10, but that misses the details of what that's all about. Business win-loss is not customer satisfaction. Business win-loss is really about the customer journey and where it comes from. It's trying to understand, why did that company go to the market? In that decision to go to the market, what were the various things that they were basing their decision on? Those decision factors. It's part of the customer journey, but it's even more that final, I was evaluating based upon these criteria and where they work. We want to understand through business win-loss how your company performed against the factors that the decision makers were using. Did you perform very well? Did you perform poorly? How did your competitors perform? How did you compared to the competitors? And particularly around all of that, what can you do tactically and strategically to improve your sales success? And when I say tactically and strategically around that, I don't mean for your sales team, I mean for your organization as a whole, whether it's changing the products you offer, whether it's changing the product mix you have, whether it's reevaluating how you provide service and support and things of that nature. So let's go and talk just briefly and move on to the business win-loss process itself. When we look at this and at business win-loss, we want to start with really understanding the key criteria that are used to evaluate a provider or a person coming into a business. I like to use a poker analogy for this. And given that SIR will be in Vegas in September, I believe is the September date, poker seems apt for today. When you walk in Vegas, you walk into a poker tables, you'll see something, table stakes. It's a little bit of a sign that says you can't sit at this table unless you're prepared to lose X dollars. There's a dollar table, a $5 table, $100 table, so on and so forth. Table stakes is what it takes for you to get a seat, to be considered as someone who might be bidding on a particular business deal. It's never enough to win. It just means you have the range of services and products that that business is going to be interested in purchasing from you. Of course, once you have the table stakes, now you're in Vegas and you're sitting at the table, you've got your pile of chips there that lets you sit there. If you want to bid, you've got to make your first ante. So whether it's a $2 bid or a $5 bid or a $20 bid or whatever it is, to open it up. In insurance, selling that means you have to have the coverage, the right kind of coverage, and the right kinds of support and services and training to get in there for them to say, yeah, you might be a potential winner in here. We're going to send some cards to you. We're going to send the RFPs out to you. We want to talk to you. Once you've been dealt your hands in Vegas, you look down and the dealer may say jacks are better to open. If you got a pair of 10s and 3 queens, okay, you can probably open. If you've got 1, 2, 3, and 7, 8, you can't open. You can't even start to bid. So in order to win again in business, you have to make sure that in that RFP or whatever, however they reach into the marketplace with their request, that you've got all the main elements ticked off. You've got everything they need. You can actually submit a bid for this. If all you're doing is meeting the minimum opening stakes, that's generally not a differentiated product from what everybody else is offering. You may be lucky you're at the table and you've got a pair of aces and everybody else has a pair of kings or queens or jacks or 10s. Yep, you got a pair. You can open and you would actually win at that case, but it's unlikely. Again, in business and in selling to services to business, having the table stakes, having the opening stakes just gets your bid opened up. Winning stakes is where we go past the minimum. I had a pair of aces. Somebody else at the table had a pair of aces. Winning stakes is I had 2 queens. They had a 1, 2, and a 3. That's the differentiation. We exceeded the minimum. We have a positive difference between our offer and the competitors. There are 2 other factors that we like to talk about when we're doing win-loss and evaluating for clients. The first one is what we call excess value. If you think about excess value, it's easiest to look at it. And again, I'll use an example. It's a purchase of a car. You went to purchase a car and you found that for that price that you purchased, the car happened to come with a sunroof, dual side climate control and heated seats. You didn't have to pay anything extra for it. You might have bought up for that package if you had known it was there, but you didn't. You would have bought it without those, but you bought it anyway. That's excess value. It cost money to put those in the car, cost money to service them and provide them, and that money was not recouped in the sale price. Example of insurance is if you offer coverages that are not really required by the company. They're nice to have, but they weren't going to pay for them if you charged them for it. But they're really happy they have them because that makes it come in as that excess value. Something they might have paid for, they didn't, they're happy about it, or something that cost you money that they didn't pay for, that's excess value. The other one is negative value. One of the best examples I have of that is a few years back, we were doing work with a company that did work in hospital supply. This company required that all of its members had their CEO participate in a CEO council. Their experience was this made for better network, made the CEOs more informed and knowledgeable and a little more sticky with them. However, in win-loss, a significant portion of CEOs said, we didn't like that. It was a waste of our time, and we're really upset that we had to pay for it. In insurance, a negative value might be doing an annual checkup on the property to make sure it's all compliant with fire alarms and so on and so forth. Nice to have, probably something that a business might say, I really don't want this. I've got the fire marshal to do it for me. Why am I paying for you to do that? It's a negative value. It detracts from what you have, from the offer that you're presenting with it. So we always want to be careful about those 2 and make sure that in that customer offer, we're presenting it the proper way. Win-loss can help you identify those steps and the excess and negative values by looking at each step in the decision process that a company goes through, understanding what their buyers' factors were, how they worked out, and how you as a company performed against those factors. Companies have different decision factors that they use, and your performance against those is really an important part of how they decide whether to go with one company or another. It's also important to understand how competitors performed against those same factors. This obviously leads to a bunch of different data collection opportunities for you and how you're going to collect data. Quite common for large volumes. Again, if something where you have an insurance product that's sold to thousands, tens of thousands, hundreds of thousands of companies, you probably want to do a good quantitative survey. Please rank our performance on a scale of 1 to 10 on this. How easy was it to do service with us on a scale of 1 to 10, so on and so forth. It's a great tool for large sample sets. It really does allow you to have a forced ranking of choices by the decision makers to tell you what they thought was important or not important. It's a relatively quick system to deploy. In other words, you can develop the survey, you can get it out to your mailing list, hit send, and it comes back in these days into an automatic collection system that will categorize each response for you with all those survey tools that we all have access to. And boom, within a day, 3 days, depending on your response rate, you can start doing the analytics of what does it mean and how do you drive it pretty fast. You can use different kinds of, you can do A/B testing with it because you've got enough volumes to come in there. What's missing about that is nuance. Why did you rate this particular feature as a 9 versus a 6? What was different about it? All of those questions around not just what did you rate, but the why did you rate it that way? Get a lot of survey fatigue too. It's not just survey fatigue because the survey went long, it's survey fatigue because almost every one of us is bombarded on a regular basis with, please fill out this survey. And the fatigue is, I just don't want to do it anymore. You know, it's kind of fun at first, but now I'm done filling out surveys. So response rates start to drop. With a quantitative, you just simply can't get an answer to a question that wasn't asked. There's no way to probe. Your response rate is going to be different, and so on and so forth. And not uncommon, goes to the wrong person. Qualitative, something that we at Fletcher CSI specialize in. A lot of other companies in win-loss look more for the qualitative side. It's much more in depth. You can ask questions in qualitative that you can't go into detail with on the quant survey. You can ask, why did you rate that? It's more of an open-ended discussion that allows for the conversation to drift off of the interview guide into areas that are of interest that uncover those funny and unique nuances that really have significant impact on the decision a company makes. You don't have to take the, yes, I thought their salesperson was great as an answer. You can probe deeper. Can't do that in a quant survey. That means we get at the nuances, and we can also make sure with a qualitative survey that you are approaching the decision makers, not those who were in the room but really didn't have any influence on the decision. It's a much smaller sample size though. Again, as I said earlier, these are the kind of surveys that might go out to 20, 50, maybe 100, 200 people. Good volume if you have that. So, but it's not the same thing that if you have a really heavy quant focused market insights group, they don't treat this as valid in the same way they would treat a survey of 10,000 people. Longer to complete because you're scheduling time with people. So it takes an hour plus or minus for a good interview. You might do 100 interviews. You can do the math on how many hours that's going to spend just on the interview itself. Costs more, much lower response. Not everybody can spend 15, 20, 30 minutes or an hour on a phone talking about the deal that just ended. In fact, we find that if it's a loss, only about 35 to 40% of the respondents or the people who lost will respond to a survey. It's about 60% for the wins. For some reason, wins just want to tell you more about how great you are. And that's nice to know, but it's much better to know from the losses about what went wrong. And the con is you're subjected to the interpretation of the interviewer at the time, which may have some bias or may not have it. There's also hybrids we've seen, use a little bit of both, use a quant to get things rolling and then a qualitative to understand dive deeper into it. It's a more complete way to get a picture of what people are deciding about your product and why they choose one over another. And you can sequence it. You can do the quant first, follow it up later on with a qual. You can do the qual first and follow it up with a quant, with a quant. Takes a little longer, a little harder to integrate that in. Those are some options that you have worth considering. So what does it take to build an effective win-loss system? A couple of pieces to keep in mind. Number one, you have to have the proper sponsorship around that. And there are two types of sponsors you need. On the full-on sponsors, it's your C-suite. The more senior the leadership is, the more likely you are to get the support that you need to make the whole program work. Product managers, marketing managers need to be a part of that. They're the ones who will ultimately use the results of business win-loss. If you have a competitive intelligence group, which most of us do, they should be a part of it because this is a competitive insight. It's not just an insight for sales. That said, if sales leadership is not involved, the salespeople won't treat this as a priority, and you won't get the support you need for any kind of win-loss in the business world. Other groups, your service department, your pricing department, your research and development department, your product development teams, all of them can benefit from win-loss, and all of them can become your advocates to have more win-loss done. Particular leaders, ideally, in our experience, it's been the CI team that is the best at leading a win-loss operation, followed closely by marketing. Both of those people look at the entirety of the decision process, not just the sales team performance. C-suite's nice because if they're involved in it, they're more likely to make changes based upon what you found. And really most often, and less than ideal, is to have the sales team run it. Sales team will tend to cherry pick only the deals that the salesperson feels they looked good in, not the deals where things went south, or if it did go as a loss, where the salesperson can say, everything we did was right. Boy, it was something else that somebody else in the organization made wrong. That's not helpful for how you're going to use that. Most of the time, this compares to consumer, where consumer win-loss is usually done by marketing. Again, it's that post-sales survey. What did you like or not like about us? So what are some of the evaluation criteria, again, we want to look at? I'm sorry, effective win-loss components. My apologies, looked in the wrong direction on my other screen. First, leadership buy-in. First and foremost, you have to have that buy-in. Next, have a consistent process. Always use the same question guide for all respondents. Make sure you're using a fixed guide, whether it's quant or qual, the same questions get asked. Timely outreach. Best time to reach a decision maker about what they liked or didn't like, we find it's about 2 to 4 months after the decision was made. That gets the highest response rate and the most engagement. Pay attention to what made them choose the way they did. Focus on that. What was driving the decision? A lot of other things might be nice, but it's that final thing. What is it that made that happen? And when it comes out of the results, when you look at the results and analyze it, what are defined actions? What can you do strategically and tactically to take advantage of the information you collected? If you don't do that, the program is not worth anything. Make sure your sales team is engaged. They have to tell the prospect, we're doing this, please get involved with it. And finally, select the right deals. Select strategic deals, select random deals, select deals where things went right or where things went wrong. So in order to make this work, first, get access to deals. If the sales team and the sales process won't give you access to deals, you can't do win-loss in business. That's simple and often the biggest roadblock to effective win-loss in business. When it's deals, make sure it's, contact points, dates, all the particulars you need to have. Decide what deals you're going to include. You might include all deals. If you only do a couple hundred a year, you may want to do all of them. If you do a couple of thousand, maybe you pick a subset. Decide how you're going to fit that subset into the deal rate into the program itself. Assign roles on your team. Who's going to get the deals? How are they going to pull them out of the CRM? Who's going to do the outreach? Who's going to tell the customer that we're going to be talking with them? If you have a contractor, how does that relationship work? Who's going to get the reports and when do they get it? Develop your questionnaire. develop the reporting structure of how you're going to do with it, and decide how you're going to monitor the success or failure of the program itself. So to wrap us up with about 6 minutes left, business win-loss is not like consumer win-loss. We're looking at very different decision factors. They are more complex in some cases, not always, but they're generally more factors involved or more people involved in the decision. So you have to go to more interviews, more contacts to get a true picture of what happened. The decision maker may not have been part of the presentations. They may have been receiving the recommendation from a council. So you have to make sure you find who made those recommendations. How did they come through with that? You need to have leadership that is consistent, that is engaged, that is an advocate for the program, and that is communicating the results of the program to the sales team and to the rest of the organization where changes come up. And it's that sales team engagement without which you can't go any further. So with that, I'm going to turn it over to Mike and see if we have any questions.
All right, Eric, that was great. Always a lot of rich information for us to consider after the event. And, you know, I'm sure everyone's head is kind of swimming in that right now. The question that we have right now in Whova is, what factors do you consider when you should get more directional insight and perspective from a smaller batch of respondents versus a study that would be more statistically significant?
There's actually a fair number of those factors that might come in. For example, you might hear about responsiveness of a sales force. That's something we hear about a fair amount. So I'm picking on salespeople. I'm sorry for all the salespeople in the team. You're absolutely wonderful. Please keep doing your work. But you hear, oh, well, the response of the salesperson was poor. That's what you might get from that large survey. With the more qualitative survey, well, how poor was it? I called them on a Monday. They didn't call me back until 3 weeks later. We had a problem with the pricing that was clearly wrong. We wanted it fixed. They couldn't do anything. Those are the easy ones. The other pieces that come out from it are in how do we compare against a competitor? We find over and over again that in most, probably about 70% of all deals we look at, the wrong competitor is identified as the chief competitor. So that's an important thing to know who you really are competing against. And then there are all the leading indicators. What did you see from a competitor that wasn't presented before that's new? And that's another factor that, again, it comes out of the qualitative, sorry, it doesn't come out of the quant in the same way because you can't probe on it. So it's just that nuances, here's what's happening, here's a way to develop a strategy to counter it.
All right. The other question is, how do you make the determination on people versus process? You know, do we need to hire better people, or do we just need to have a better process?
I'm going to hope that that's about the sales process as opposed to the salespeople, as opposed to the win-loss process. You know, the people respond to the process that you have in place. So if your sales process is approaching a prospect at the wrong time, or is presenting information through a packaged, you know, this is the way we sell book that doesn't resonate with your customers, it's time to change that process. The salespeople may be doing exactly what they're supposed to, but the process may not be working right. If you're approaching your market at a time when they're not ready to buy, again, you know your industry, you know the cyclicality of when people buy, when companies make their decisions to purchase. If you're coming in 3 weeks late to the party or 6 weeks late to the party, you've probably already missed your opportunity. So again, your process needs to be adjusted for identifying when those opportunities come up.
Mm-hmm. I found a lot of similarities, I think, between your presentation and the one just prior from Zeldis. You know, when Amy was talking a lot about different tools and pros and cons of different methods for quant and qual, primarily qual and hers. But this question is similar to what we talked about before around incentives. Do you, in win-loss, offer incentives to boost response rates? And if so, in a business type environment for win-loss, what type of incentives would you offer?
It's a touchy one, in part because you don't want to make it appear that it is a reward for someone who selected your company to have that, to give them money for it. But at the same time, a lot of individuals you're going to take an hour of my time. I'd like to get compensated for it, particularly if they're doing it off business hours. Mm-hmm. So our process, really, we start by saying, all right, before we even begin, we need a senior leader from the company to send an email out directly to that decision maker. Hey, we're working with Fletcher CSI. We're doing win-loss. We really value your insight into why you made the decision you made. Expect a call. Please go through with it. What that does is it doesn't provide that individual with a financial incentive, but it tells them, one, you were really important to the company. Whether you won or lost, we value what you have to say. Two, it gives them an opportunity to vent if they didn't like what they got and say what was wrong. And three, the messaging always has to be, the next round, we want to be better at meeting your expectations, whether we won or lost. So this is going to help us be a better partner or a better provider for you, whether you pick with us or not. If all else fails, yes, sometimes an incentive might work, but it should never be very much. You have $50, $100 adjusted for inflation, which means it's probably worth more than that now. But it can't be enough that it would sway a decision.
Yeah.
Ethics has to be a big part of that decision, how you're going to do that.
Makes sense. So I think, using this methodology, you get a lot of information from the buyer decision maker around, why they chose to go with one business over another. And at the end of the day, there'll probably be some weighting. I mean, you talked a lot about how price is very much a driver in the consumer market, where in business it's more relationship and quality of coverage and a lot of issues like that. Two questions here. I mean, one, at the end of the day, do you qualify the weighting and the strength of certain factors that drove a decision to say, if you're only going to pick two areas to focus on, these are the two? And then second, how do you learn more? Well, I'm not sure if you can answer this one, but some of the information about the competitor that may have influenced those things. We mentioned process over people and things like that. The buyer might not always know or have insider information about, the other companies that showed up. So I don't know how you address those two things.
I'll start with the weighting one first. It's something we find repetitively is that companies look at the decision factors and they treat them all as equal value to the decision. And so they might say, well, on this particular factor, you ranked 5 points, 10 points higher than the competitor. And they say, that's great. We don't need to worry about it anymore. And on this other factor, you rated equal to the competitor. Oh, okay, we got to improve that. Or on this other factor, you weren't doing really well. The competitor was much better. So we got to fix that factor. But when you evaluate the weighting on it, it turns out that the factor where you were equal was the single most important factor. So that's the one you really have to differentiate on. And the company that wants to go and do a lot to improve on a factor where they were lagging, turns out that was the least important factor. So if you're going to invest in improving your product and your sales process, you focus on the most important decision factors, regardless of your performance on them. If you're ahead of a competitor on that most important factor, how do you maintain that lead? If you're behind a competitor on a factor that's largely irrelevant, do you really need to do anything about it right now? Mm-hmm. That's an important way that you use weighting. So what's really important in the decision, where you need to have the advantage. And I apologize, I wrote down weighting and I didn't write down the other one.
No, it's just, I think we were just thinking about, I mean, there's I think a lot of focus on why they went with, the decision factors for why they chose you or they chose another firm. And we know our processes and expenses and business model and a lot of those kind of things, we may not know as much about the competitors' processes and expenses and business model. So I don't know if in the win-loss process, if you bring those other insights in to say, here's the profile of this other business and their cost of acquisition and their, key metrics and other things like that, that you can use to amplify the buyer's choices and the reasons that they did that.
Certainly. So my perspective, again, being a competitive intelligence guy, I look at everything through the lens of what's the CI angle here. Win-loss should drive your CI. You should use the win-loss to understand if you are behind a competitor in an area. Why? What's driving their ability to be better at this than you are? Is it just they got better presentation and a deck than you do? Or is it something about the inherent nature of their structure and organization? If their price is significantly lower, how are they able to do that? That should be driving a CI to study to understand what makes that happen. If their process is different, they have a different way of going to the market. Same thing, that's a CI study. What are they doing that's different? What can you learn from it? So in that respect, effective win-loss is going to drive change internally for how you develop new products, go through there. It's going to drive change externally by identifying what competitors are offering in the market space earlier than you are, or what trends customers want before they have enunciated them. And it's going to drive additional CI to understand how a competitor is able to present and deliver this product into the marketplace in a way that is competitive and potentially advantageous against yours. Yep. So yeah, it's a CI product.
Sure. So it's one part of an ecosystem of the competitive intelligence, informed decision making. So perfect. Before we jump to break, and I just have one last question. I don't see any others in the application. I didn't know if you had any additional words about what the final artifacts look like. Is it typically, a presentation, here's a deck, and y'all brief it to the client, or is this a report? What does it look like, and some of the different reference material that's inside of it?
So we're not different from our competitors in this respect, in that we issue two critical deliverables on it. The first one is the individual deal report. So what happened in this deal? And it's easy for a lot of people to get lost in those. This happened in this one deal. It happened once. Boy, that's the biggest issue. The second one is more of a complex roll-up, frequency of which certain things happened. Why did they drive through that? Recommendations for change that can come about from it. It's a key part of the process is that moving past this deal to all of these deals. Here's what we consistently see. And that drives recommendations for, if you consistently see a very strong positive, how do we make that become more of a positive for us going forward? So that is a part of the total package. Again, individual deals, roll-up deals. Typically, in our case, what's ideal is we do a presentation that includes the sales team, the marketing team, and some of the other product development teams to be involved in this, because they're going to hear the voice of the customer telling them, this is what we want when you come to us to sell us a product.
Yeah, awesome. All right, well, thank you, Eric. I appreciate it. Always, like I said, great information and things we can go back and, include in our own processes, even if we're doing something outside of the B2B world. I'm sure there was a lot of great things there that we can incorporate if we're focused more on the individual market or whatever. So that was awesome. I want to also thank you for your sponsorship once again for the spring workshop. Really appreciate not only the thought leadership, but the financial support of SIR. And I would remind everyone that we're going to take a break here before our next session. But please stick around for the networking activity at the end of the day. You could be the lucky winner of a $100 Amazon gift card. So See you in the next session, everyone, and thanks for joining.
Thank you.